Here is something that most home buyers don't know. Big banks like your Chases, your Bank of America, your Wells Fargo, they lose about $4,800 on every mortgage that they write. And yet they keep lending. Why? Because saying no to you is actually part of their money-making strategy. So today, I'm gonna break down for you the mortgage strategies that banks don't ever talk about, nor do they want to. It's called non-QM lending, or referred to as alternative income loan. These are bank statement products, qualifying based on your assets, qualifying based on the rents for an investment property. And this is how I would personally buy in San Francisco and want to help you do the same thing before the market starts to heat up and go all batshit crazy again. After working the Bay Area market for 20 years and being in the industry for 24, this is the exact playbook that I would use if I were going to buy a home in 2026 anywhere here in the Bay Area. And before we jump into this, guys, let me reintroduce myself to you. I am Arjun Dhingra. I am a 24-year veteran of the mortgage industry. I've been doing loans for hundreds or thousands, I should say at this point, families and individuals right here in the Bay Area, helping them break into a super competitive market. And if me and my team can help you through the process in any way, whether it's putting together a long-term strategy or doing something right now, then please reach out to me on Instagram at Arjun Mortgage, and our team would be honored to assist you in any way that we can. Thanks for watching this video and for following this channel. Now let's get into the topic. So let's clear up something right away here now. When banks reject you or turn you down for a mortgage, it's not because you're a bad or an unworthy borrower, which is how most of us take it. It's really personal. It sucks. Rejection doesn't feel good, regardless of the context that it's part of. But over these last couple years, 2024 to present, about 21% of purchase mortgage applications were rejected, and just over 25% of refinance apps were turned down. And no, it has nothing to do with people's credit score. It's the business model. Now, this might infuriate a lot of people, but when you understand it, it's going to make sense. It's called the loss leader game, and it's been around for a long time. I want you to think of Las Vegas casinos. The reason why a hotel room in Vegas is often comped to you at the end of the night after taking some bad losses on the table, or they were just dirt cheap to be able to get into in the first place, is because, you guessed it, they don't make any money on those hotel rooms. If anything, they operate at a massive loss for that part of the business model. But it's a loss that leads into their bread and butter, which for Vegas is gambling. If you're staying at a hotel for either free or dirt cheap, you're very well likely to go downstairs, eat in their restaurants, and spend your hard-earned money at those tables. And last time I checked, guys, this model works because they don't build those places by paying winners. Everyone loses. And this is very similar to how banks operate. They actually lose money on mortgages. Jamie Dimon himself said it just this last year when making some commentary about how mortgages are actually sour for him when he thinks about their entire model. That makes people scratch their head thinking, how could such a hot industry be sour for the biggest and most successful bank in the world? But they do actually lose money on mortgages, and they do them and offer them to you so that they can get you to do other things. Open a checking and savings account with them for starters, other investment accounts, moving your assets over from your other financial institution or whoever manages your retirement accounts or your long-term investments so that it can all be managed by that private wealth division of that bank. Credit cards, insurance, personal loans, lines of credit. Your entire financial life for the next 30 to 50 years is going to be with this place, and that is ultimately how they're going to make lots of money off of you. This is why First Republic Bank was as popular as it was right here in the Bay Area. Everyone loved them because they gave away 2% interest rates. Real estate agents couldn't get enough of them because every time they sent their client there, the client would walk out saying, "This is incredible. I just got a 2% interest rate or a 2.5% interest rate." Well, the bank was losing a lot of money on that. It was given to them with some conditions that they would move over all of their assets or sign up for some other services that the bank had to offer. But ultimately, because they couldn't manage their interest rate risk, when the mortgage rate market started to take off and interest rates in general got higher as a result of inflation, it caused the bank to completely capsize. So I wouldn't count on that model coming back at that aggressive level anytime soon. But you guys understand now what was the motivation behind what they were doing. And most all of the big banks are still doing this today. So when a bank says, wait for 2 years, or you need 2 years of stable employment with that W-2, or we don't allow this kind of documentation, what they're really saying, what the translation is come back when you fit our system. For a lot of you, this is going to be infuriating. For others, it's going to make complete sense. And it's my job to help you understand the difference between the types of lenders that are out there and who the big banks are really on the side of. It's basically the people with the biggest pockets. And that's not everyone. In fact, most of my clients don't fit that model, which is why we work with them so well. And guys, this is especially brutal right here in the San Francisco Bay Area. The median home price, $1.4 million. The income needed to qualify traditionally for that type of a mortgage or median home price, roughly $230,000. And most buyers here make their money on commissions or very low salaries and huge end-of-year bonuses. They're self-employed, they're entrepreneurs. They are the founders of some of the companies that are going to change the world. And while what they're doing is hugely important, from a societal contribution standpoint, they are worthless to a big bank when it comes to actually qualifying for a mortgage and being able to get a house. So let's get into some of the strategies that we use all the time to help people that fit this buyer profile. And the first strategy is using bank statements to qualify, or bank statement loans. Now, these are what I like to call the self-employed cheat code, and it's where non-QM lending or alternative income gets really fun. And full disclosure, the majority of the non-QM loans that we do right here at my bank are exactly this type of mortgage product. So bank statement loans allow you to omit the one thing that's getting you into trouble or making you look bad, which is your tax returns, and use the actual cash flow that you get that's coming into the bank to be used to qualify. So here's how it works in plain English. We look at 12 to 24 months worth of bank deposits. No tax returns are required, and you business owners are not punished for all those write-offs that are allowed within the US tax code. We apply an expense factor to those deposits, and that gives you qualifying income to be used on the mortgage application. So here's an example. $20,000 a month deposited into your business account, we would count about 50% of that as income. So that's $10K a month or over $120K a year. Even if your tax returns show that you make virtually nothing, you now, for purposes of a mortgage with us, have $10,000 to go towards that qualification. Now, here are some of the key details with this. Credit scores can be as low as 620, but a 680 plus is going to be much more favorable for you from an interest rate standpoint. Down payments can be low, going as little as 10% or up to a more traditional 20 to 25%. Loan amounts can go all the way up to $4 million, which really help fit the Bay Area's model. And your debt to income ratio can go as high as 50%. So this type of a mortgage absolutely crushes it for the following people: business owners, consultants, freelancers, tech contractors, real estate investors, anyone who's on commission or heavy bonus structure, founders of companies. And yes, I'm going to tell you this right now as a bold statement. We have closed a mortgage for someone that was turned down by a bank in as little as 14 days using one of these products. So now let's move on to a little bit more of a creative, but still very sexy loan product for really high net worth borrowers called the asset depletion loan, or asset-based qualification. Now, this mortgage product blows people's minds, and I'm still amazed by it. If you have assets but very low taxable income, then this might be your product. And you don't need to sell your investments to actually buy the real estate, which is what a big bank would tell you. So here is how it works. A lender looks at your liquid assets, divides them over a set period of time, and this gives you your qualifying income. Similar to a bank statement product, you have a expense factor that's applied. Same thing happens right here with your assets. So for example, let's suppose you have $1.2 million in assets. That is divided by 84 months, which gives us $14,300 a month in qualifying income. No W-2s, no tax returns needed, $14K a month, and now be put down on paper for your mortgage application to qualify towards a new home. Now, these assets that you use for qualifying can include cash, stocks, investment accounts, CDs, and sometimes your retirement funds. Now, here's why this matters in San Francisco. If you've got $2 to $3 million invested, but only show $75K in income on paper, the banks are gonna laugh at you. Asset-based lenders like us don't laugh. We actually look at this and nod in agreement with you. One, because you've been really good at what you've done to get to this point. And two, we just do the math because it makes sense. Now, there's also debt service coverage ratio loans, which allow you to use the rent from a property to qualify when buying it. And these are super popular for investors that are trying to buy single units or multifamily. And with us at our bank, we can go all the way up to 10 units for these types of loans. So while a traditional commercial mortgage would be used to buy a 10-unit property, we can actually do it in-house for you and qualify you strictly on the rents for that building. Also very popular for people who are self-employed or just don't show a lot of income on their tax returns. Now, it's important that everyone understand the game that you're playing here in 2026. Independent mortgage banks, private banks like ours, made money in 2025. Big banks did not when it came to this space. And that tells you everything you need to know about the state of the mortgage market. So here's what a smart buyer, which is you, is going to ask a lender. What non-QM options do you offer? Do you do bank statement loans? Do you do asset depletion? And how fast can you fully underwrite me and eventually close my transaction? Because this is going to give me, or you, the buyer in this case, all of the leverage when it comes to your negotiation. Now, here are the keywords or sentences to ignore and stop talking to that large bank and come talk to somebody like me that understands you. Come back to us in 2 years. We can only work with you if you have a W-2. The response to that might be, fuck you. No, I'm just kidding. You get what I mean. Assets don't count. Sorry, we don't do that type of lending here. That's not advice that they're giving you. It's the wrong lender, and they want you to fit their model. It's part of the game. So don't play their game. In 2026, play your own and one that you win, and partner with somebody that wants you to win as bad as anyone. Now, I'm gonna tell you why 2026 is a huge window of opportunity for everyone involved in the game. And this setup that we're talking about does not last forever. Here's what's lining up for this upcoming year. Mortgage rates are going to continue to trend lower and probably break well under that 6% threshold, which means we're going to finally have a 5 handle on most mortgage products that are out there. And that has been studied and understood to be that psychological tipping point for a lot more people to move in this market, whether it's choosing to finally list and sell their home or get out there and buy something. Now, a few years ago, anything with a 5 would be considered insulting or too high, but given that we've been in an elevated rate environment now for 3 steady years, anything with a 5 in front of it is going to be very refreshing. Inventory is starting to stabilize in many markets. Prices are no longer spiking like they were during the pandemic. Multiple offers are decreasing, not fully gone yet, but getting a little bit more under control or normalizing. And AI and tech money is still flooding this area. So remember this when rates do eventually drop. You're going to have more buyers entering the market, more competition. First-time buyers are going to come back in with a lot more confidence, and investors also start to pile in. So the move for you is before all of that happens. And I love using the Apple analogy. Remember, the time to invest in Apple stock is when Tim Cook or someone from Apple announces the iPhone that's coming out next year, not when you drive past your neighborhood Apple store and you see a line all the way around the block. By that point, it's too late. So very similar here to the real estate market. So now I want to give you guys a bulletproof 3-phase plan to be able to enter this market with some confidence in 2026 and make sure that you win. So phase 1 is what we are going to do right now. Clean up your accounts, organize all your statements, get some non-QM options lined up, and work on pushing that credit score above a 680, because that's going to put you in the most optimal range for qualifying options and getting really good interest rates. Phase 2 is about 3 to 6 months out. So once completed with phase 1, we now want to work on choosing the right loan strategy so that you have what I call the loaded gun, which means you're fully approved and you can jump on a property if you want to or take your shot at any time. And have multiple approvals, meaning we want to be approved at various interest rate ranges so that you know what your buying power is. If there's any volatility in the market or if mortgage rates spike or crash, whatever the case, you just want to be prepared. And then phase 3 is to actually shoot. Whatever you see your window in the market, whether it's because rates have dipped even more and there's more stuff coming on the market, or it's before that, as we talked about, as the optimal time to buy, use a very quick close as your weapon for negotiating the best deal. For our buyers, being able to close in 16 days or less has been one of the more convincing negotiating arms that they've been able to really leverage. And you win before the crowd wakes up. When rates dip and people start to read the headlines and they think, okay, let's get back out there, you should already be sprinting towards the finish line on a property. And in this market, in San Francisco or the Bay Area at large, speed kills, period. So here's the bottom line, guys, as we wrap this up. Banks want you to play by their rules, the old rules. The smart buyers like you won't. Now, if you're buying in San Francisco and you're an entrepreneur, you're self-employed, you make your income through different channels, if you're an Uber driver and you want to buy, then this stuff matters. Again, reach out to me on Instagram at Arjun Mortgage to learn more about these types of products. We've had the privilege and the honor of helping so many people break through in this market when they thought they had no hope or options and that their home search was basically dead and they were stuck for years, and finding ways to break through right now. It's what I love most about this job, is succeeding when others are telling you that you can't. So let's team up and make it happen in 2026. Thanks for watching this video today, guys. Please subscribe to this channel so we can reach you with more content like this, and we'll see you on the next topic.